the monetary policy response is the aim to restore confidence in stability market. All the monetary policies measures the ZIRP, QE, and emergency lending funds were designed with the main goal to restore confidence and financial system by ensuring the bank had access to the funding and that market had sufficient liquidity. The central bank helped calm investors, reduce panic, and stabilize financial security. Next is we will move on to the international coordination. The, the first is the G20 summits. It's promote coordinate fiscal and monetary policy. During the 2008 global financial crisis, the group of 20, which includes the world large development emerging economies, played a crucial role in organizing a coordinated global response. The leader of from a major economies such as United States, China, Japan, and United Kingdom, Germany, and the others gathered an emergency G20 summit to address the rapid spreading economic turmoil. The G20 agreed to implement synchronized fiscal stimulating program, coordinate monetary policy, and enhance financial regulations. Next is the MF expanded lending capacity. The International Monetary Fund stepped in as a global financial safety net during crisis. Many countries, especially developing and emerging economies, face balance of payment problems, meaning they were struggling to pay for import and services their foreign debt because of the capital flight and declining export. To address this, the IMF expanded its lending capacity and created new financial assistance programs to provide emergency support and prevent economic collapse. These are the flexible credit lines. The flexible credit lines was introduced in 2009 as a quick access loan for countries with a strong economic fundamentals and sound policies. It provides large upfront financial support without the traditional lengthy conditions, allowing countries to draw funds immediately if needed. The next one is the precautionary credit line. The precautionary credit line was designed for countries that were generally strong but still face moderate vulnerability. It provides a approval line of credits which countries could use if their situation worsens. Lastly is the global cooperation to prevent deeper financial collapse. The combined effort of G20, IMF, and World Bank and the other international organizations showed unprecedented global unity. By coordinating policies, increased financial support, and reforming financial systems, they managed to stop the crisis by escalating into another Great Depressions. These cooperations help stabilize global financial market, support trade and investment flow, protect developing economies and severe downturn, encourage long-term reforms in a bank regulation and transparency. Now, the last topic is the long-term impact of the global financial crisis. The first long-term impact is the massive public debt accumulated due to bailout and stimulus spending. In response to 2008 global financial crisis, many governments launched large-scale bailout programs to rescue failing banks, financial institutions, and major corporations. At the time, at the same time, they implement fiscal stimulus package, increase government spending, and reduce taxes to revive economic activity and create jobs. While these actions help prevent the total economic collapse, they also cause massive increase of public debt. Countries like United States, the United Kingdom, and several members of European Unions saw their national debt to GDP ratio. Next is the persistently low interest rate for more than a decade. After central bank adopted the zero interest rate policy, during the crisis, interest rate remained historically low for over a decade. The goal was to sustain borrowing, investment, and spending during the slow recovery period. While the policy helped boost economic growth, it also had a side effect. Next is the shift toward macro-prudential regulation to monitor systemic risk. One of the key lessons for the crisis was the regulators had focused too narrowly on individuals' institutions rather than entire financial system. As a result, there was the major shift toward macro-prudential regulation, which aimed to monitor and control risks that affect the financial systems as a whole, not just a single bank. This new approach includes the tracking systemic risk, setting counter-cyclical capital buffer, and implementing stress testing to evaluate how a bank would perform under extreme conditions. Next is the implementation of Basel III and the Dodd-Frank Act for Financial Stability. In response to the failure exposed by the crisis, new regulatory frameworks were introduced to strengthen the global financial system. First is the Basel III. The Basel III Accord, introduced by the Basel Community of Banking Supervision, required banks to hold higher capital reserve and maintain better liquidity ratio and limit leverage to reduce overborrowing. The Dodd-Frank Wall Street naman is Reform and Customer Protection Act in US. In the United States, the Dodd-Frank Act was passed to increase transparency, accountability, and consumer protection in the financial system. It created new regulatory bodies such as Consumer Financial Protections Bureau and exposed stricter oversight on the large financial institution. Lastly is the renewable global focus on risk oversight and financial reform. The 2008 crisis revealed deep flaw in financial regulation, corporate governance, and risk management. In the aftermath, there was renewable global commitment to strengthening risk oversight and perform financial system. This international organization, and private institutions begin emphasizing transparency, accountability, and stronger corporations. That's all about my report.